Let me tell you a secret. Some of the biggest rallies in US stocks, crypto, and even real estate started with people borrowing money in Japan. Not investing in Japan, borrowing. Because in Japan, money has almost been free. This is known as Japanese yen carry trade. And when it goes wrong, markets don't correct, they panic. Today, we're breaking down one of the most misunderstood forces in global finance, what the yen carry trade is, and why Japan became the world's piggy bank. How investors quietly profit from it, and why a sudden move in the yen can send shockwaves through global markets. Stick around because once you see it, you will start spotting it everywhere. Think of the yen carry trade like a credit card with zero interest. Wouldn't that be lovely? We're currently at like 28% interest rates on our credit cards. If your bank offered you free money, you'd probably use it. That's Japan. For decades, Japan's interest rates have been near zero, sometimes negative. So global investors borrow yen, convert it into dollars, and invest it elsewhere. They buy stocks, corporate bonds, real estate, and they put that into emerging markets, high risk, high return assets. The logic is simple. The math is simple. Borrow cheap, invest higher, and repeat. As long as nothing breaks, the system doesn't break. It's a money machine. Japan didn't plan this though. After its asset bubble burst in the 1990s, Japan faced decades of slow growth and weak inflation. In fact, deflation. The Bank of Japan kept rates low, artificially low, to stimulate the economy. They kept them low for years, actually decades. The yen became cheap, stable, and predictable. Perfect for borrowing, so instead of holding yen, investors used it. Japan became the quiet backbone for global liquidity. Not flashy, not loud, just funding everything. The yen carry trade thrives in calm markets, when volatility is low, when central banks are predictable, when risk feels safe. Investors make money in two ways. First, the yield gap, borrow at almost zero, earn higher rates, returns elsewhere. Second, currency drift. If the yen stays weak or slowly declines, repaying loans gets cheaper over time. It's like getting paid twice. If the yen stays weak or slowly declines, repaying loans gets cheaper over time. That's why this trade can run for years without anyone noticing. Here's the catch. The trade is fragile. If the yen strengthens quickly, everything changes. Suddenly, repaying yen debt costs more. Losses stack up fast, so investors rush to the exit. They sell stocks, they sell bonds, they sell anything liquid, anything to increase liquidity. Not because fundamentals changed, but because the math did. This is how currencies moves becomes market crashes. Carry trade unwinds don't unfold slowly. They avalanche. They build on one another. But here is why it matters. If Japan tightens policy even slightly, global liquidity tightens. A stronger yen acts like a vacuum, pulling money back home. Risk assets feel it first. Tech, crypto, speculative stocks. That's why traders obsess over the Bank of Japan's meetings. Not because Japan is exciting, but because Japan pulls the strings. They are an indicator. The Japanese yen carry trade is invisible when it works, but when it unwinds, it leaves fingerprints everywhere. The next time markets drop for no clear reason, check the yen, because sometimes the real story isn't earnings, it's currency debt. If you want more videos breaking down the hidden mechanics behind market moves, hit a like, subscribe, and comment what topic you want next. Be blessed.